Hello, I'm Tony Kay. I'm the editor of Eureka Report. Welcome to today's Advisor Q&A session, preparing yourself for June 30. I'm joined by Bruce Bramall, Licensed Financial Advisor. Hi Bruce.
How are you going, Tony?
Very well. And Max Newham, also Licensed Financial Advisor.
G'day, Tony.
Welcome, Max. Thanks for coming in, gents. Well, as I work it out, we've got about 14 and a half days or so to June 30. So are you guys able to stick around for the next 14 days?
Sure, not a problem. We open up the hotlines.
I just thought we'd try something different this time and just run a marathon event.
Definitely.
Okay.
So we've got plenty of questions. We're going to try and get to all your questions today, but I will put a disclaimer in there that we may not. We'll do our best. If we can't get to your question today, we'll aim to answer those probably in a column. We'll have a look at what the question is and may be able to work that into a column, but we'll do our best today. The other disclaimer is that we can only provide you with general advice, not specific financial advice. So some of your questions that have come in, I can see, are fairly specific. So we can answer them, but in a more general way. If you do need specific financial advice, which I would always urge you to get, then you should seek out the help of a specialist, a licensed financial advisor, such as Bruce and Max.
Yes.
So, welcome here again. We'll go straight into the questions, really. Today's session is about June 30. There's obviously a lot of super changes coming in, but as always, June 30 is a milestone, a deadline for tax. So people who have any tax questions may want to ask them as well today. You can ask questions along the way. We do have a fairly full board already, but feel free to ask questions and we'll try to get to them. Okay, so I'm going to bring my trusty laptop onto here so we can kick off. The first question, I'll deliberately put this to you, Max, just to keep a bit of sequence going. But this question's from Jeff. He has two separate pension accounts. One has been set up as a non-concessional account, so everything in there is pretty
Taxable.
much.
It's all taxable.
Yep.
Super, yep.
But non-concessional contribution, so yeah, it's
So it's got
tax-free.
a high level of tax-free.
yeah,
Right,
high level
okay.
tax-free. The other one's got a 30% taxable component. So Jeff's going to have to commute some funds back, he says, on July 1. Which is the best account to commute them back to?
I feel like I'm in politics sometimes when I say it depends. The situation is, it can make sense in these early stages when you're in the minimum draw, in the low drawdowns, the 4, the 5s and the 6%, to be maximising your pension balance in the superannuation with the tax-free, because the name of the game is to maximise the tax-free component of your superannuation when you pass on to limit the tax payable by your non-dependent children and other non-dependents that may get it. And this is why you have to do some careful calculations. The beauty about keeping it in pension phase, the 100% stays the 100% forever. If the 100% pension is rolled back over time, that will end up being degraded because of the income coming in. As a general rule, forgetting that bit of a caveat I put on it, that there will be a time when there has to be a fair amount coming out because as the minimum pension balance or minimum pension payment increases, but I would say you would want to maximise your tax-free pension component, commute and roll back to accumulation the amounts that you are in excess of your cap, draw down the minimum pension at all times on your pension account balance, 1.6, and then anything you need over and above that comes out as partial or commutations as tax-free lump sums. So yeah, it was a political reply to start with, but generally that's the best.
Yeah, just to make that even clearer though, so minimum drawdown from your pension account, anything else coming from the accumulation or what you've had to roll back. Yeah.
Yeah. Okay, thanks, Jens, for that.
One interesting thing can be is if there's a portion of the taxable tax-free component, super pension still left in the super fund, and the person's not yet 65, there is the ability, even with having reached your pension transfer balance cap, to be able to commute 300,000 of that at the 30th of June in a year, goes back to accumulation, your 1.6 goes down to 1.3, and then the 300,000 can go back on the 1st of July as long as you're able to make that, which can end up helping improve that tax-free component of, if any of that pension, which is the mixture, is still remaining in the pension phase.
Yep. Okay, and actually, on that 300,000 figure, there's a question from John. He's saying they've downsized their home in late 2015. When will it be possible to contribute 3,000 to our super? Is there an age limit?
My understanding is that it will only, if you've sold it in 2015, unfortunately, you're not going to get,
not
get the
captured
ability.
yet.
It will only be property sold, I assume, after the 1st of July, Max? Or was it budget night? I think it'll be the 1st of July.
Yeah.
But that, I don't know that's even passed.
No,
through yet,
I mean, there's so many pieces of legislation, and a lot of this stuff with the pension transfer account balance, despite it having been announced more than 12 months ago, it took so long to get through the Parliament. And who knows what this particular measure is going to look like by the time it comes out of
it was only in the budget a month ago. I don't think it's been legislated yet. But if you sold in 2015, I don't think there's any hope.
Too early.
That you'll be able to, unless you meet some of the other.
Yep.
If they're talking about that 300,000 from downsizing your home, and that's the assumption that we're making at the moment, if they're still able to make contributions, non-concessional contributions by being under 65 or meeting the work test over 65, which you can't use the pull forward, but they might still be able to make contributions to super, but not under that downsizing announcement that was made in the budget a month ago.
Yeah, nothing stopping them from doing that.
So if they're under 65 now and haven't ended up exceeding their non-concessional contributions in the previous 3 years, they can get $540,000 each in as long as they meet those criteria.
Yeah. Okay. Got a question from Gillian. It's around the segregation and proportional type issue. Referring back to one of the articles we've run, but she just wants a bit of clarification on it. So Gillian asks, my understanding is that the current SMSF, that if a current SMSF is not segregated, then the proportional method must apply and one cannot pick and choose which assets to leave in the pension fund. Is that right?
No, in fact it's more the other way. If you have a super fund where it only has pension accounts, it is automatically classed by the tax office as being segregated. The only time you can have a situation where a fund has the choice to use proportional or segregation is where there is a mixture of accumulation accounts and pension accounts. And there's always the ability for the trustees to choose at the start of each financial year as to whether they're going to be using the segregated or proportional. So I was at a session yesterday and I put up the fact that if trustees end up doing a minute to say from the 1st of July they will be using the segregated method for the 2017 year, should that be okay? The presenter said the only possible problem would be is if the tax office started to want to look at people that had previously been proportional and gone to segregation and bringing out the ugly part for a tax avoidance stick. But I think the tax office has got a lot more things on their plate to worry about than starting to be able to drill down, and as long as the documentation's in place.
I do think, though, Max, I know you and I have talked about this previously, I do think the ATO will take a dim view if this happens in the tens of thousands. I think if there are tens of thousands of self-managed super funds saying that they went to
Segregation.
segregation on the 1st of July 2016 for the FY17 year. I just get the feeling that they would that there could be something further. It's a lot of work to do for them, but the stakes are pretty big for the ATO.
The interesting thing is, to be able to get up under Part 4A, they have to be able to say that the prime purpose for doing it was for tax minimisation. There is a duty under the Trustees Act that the trustee must at always time put their beneficiaries first. And in this case, the beneficiaries are the members. And if the members could be saying, hey, I'm going to suffer financial disadvantage by not using the segregation method, if I'd known earlier, I would have been using it. So I think that would be a greater counterclaim. So I think in the end, I think it's a better than 50-50 option to choose.
Okay. That's just a very complex issue, the whole segregation proportional area, which I know.
It is, but it isn't.
Yeah.
If you can segregate, you are a lot better off than using the proportional. Because if you use proportional, a portion of the capital gain you're wanting to protect will be taxable.
Yeah.
If you use segregated, none of it.
Now, talking about taxes, Kathy asks, she has over 1.6 million, substantial capital gains in a managed share fund. Can she apply for capital gains tax relief as she can for individual shareholdings?
In the managed fund?
Yeah.
Well, yes, it's no different. Every single asset, if you're going to, when you need to do that, you're going to need to do it for every single asset, and that includes managed funds and property and bonds and shares and the like. So, yes, if that's an asset of the super fund and there's considerable capital gains in that asset, then that is one of the assets you'll have to go through line by line to make the decision as to whether you want to apply for the CGT relief or not moving forward post 30 June.
Am I allowed to ask a question?
You can, Max.
Good. Bruce, interesting at this presentation yesterday, I'd at one point mistakenly thought under the proportional method you had to claim you had to do all of your assets back to market value, and you couldn't pick your assets. After checking with the tax office, I found out no. You could actually decide what are the assets that you are going to be claiming the capital gains tax, and you didn't have to do it for any or all.
No.
But I have been told, though, that you still do have the choice of picking to have the capital gain exemption applied to everything.
You can, yeah.
But then would you be right? And when I was thinking, I was like, it'd be hard to make a case for doing that, because if you've got assets in there that are in loss stage...
Absolutely,
yeah.
So the whole point of this is you might have a property you bought for $300,000, it's now worth $700,000. You're likely to sell that at some stage. You want to protect that gain. Bang! You want the CGT exemption, rollover relief on that one. But you might have bought some BHP shares at $50, or Rio at 130, 40, 50, whatever they got to, and they're sitting at half those values or whatever now. You've held on to them for a while. They might be one of the assets that proportionally, or that you are going to shift back into your pension, into your accumulation account. And if you've got, pardon me, a loss there of $10, $20, $30, $40,000, something bigger than that even, that is sitting there for when something else you sell in your accumulation fund has a gain of $50,000, then you write one of those two off against each other. So when you say or talk about going through asset by asset in your fund as to which ones you want the CGT relief applied to, it means asset by asset. In most cases, ones with gains on it you'll want to apply for the relief on. For those ones that don't, they're sitting on losses, there's a very good chance that you want to not apply for the relief on that, so that if there's a benefit. The other side is that it's a little more, that's very simplistically. There are other things that you might need to take into account. Another fact about this is that if you do apply for CGT relief, it resets the cost base back to June 30, closing price on June 30, or for property, the value, determined value on June 30. That becomes the new cost base. So if you apply for the CGT relief on an asset you bought for $1, it's now worth $10. You apply for that relief to be applied to on June 30. If you subsequently sell it, and a portion of that asset is rolled back to accumulation under the proportional method, then let's say it's 50%. 50% of that asset is rolled back. If you then sell the asset a couple of years later for $12, then the CGT relief will apply up to the $10 mark. You'll be paying some CGT on the extra $2 worth of gain that you've made on that asset, in proportion to what is sitting in pension and what is sitting in accumulation. So if you had 50-50, then the $2, you've got a $2 gain on half the assets here, so it's essentially $1. You get the capital gains reduction of 1/3, and then you're paying tax on that proportion of that amount that's sitting in your accumulation account. So literally, it's line by line, it's asset by asset that you're going through to determine whether you want to apply for CGT relief on or not.
Yep.
And I think the only time you'd probably want to go for the 100%, because one of the things that's probably not as well understood is that yes, you can claim the CGT relief on the value of the assets you're rolling back from pension to accumulation. And the interesting thing is there's even a tax office example on this where someone may have a situation where, let's say, they're $1 million over the 1.6 cap, and they may have some shares to the value of 500,000, some managed funds of another 500,000, which is, they've still got extra to go. They may have a property there that has a large capital gain accumulated there. There is nothing stopping them to say, well, I'm going to transfer that back, which means their 1.6 million would go down to something less, because you can only do whole assets. And in fact, in the tax office example, this is what they basically said. And there could be a very good reason to do that, because 1 July, when it comes around, any super fund that's got more than the 1.6 in the pension transfer balance cap, they can no longer use segregation. It's proportional. So if you don't claim the capital gains tax exemption now, when that asset gets sold in the future and you have maintained an accumulation account under the same super fund where your pension is, whatever that proportion is, whether it's a half or 20%, will be taxable in the future. So really the big thing is, as Bruce said, it's a line by line item, and our subscribers, our listeners, our viewers must get advice, because it's not the sort of thing you can have a blanket question. There's a lot of tax and super strategizing that needs to go in, and this is going to be one of the busiest years. I think this is even bigger than 2007.
The other side of it also is that the decision that you make is irrevocable. You can't change your mind on it. The decision needs to be made and put in at the time of or before you lodge your 2017 returns, which might be up until May 2018. But the decision that you make at that point is irrevocable. You can't change it. The reason that's important, and to get it to go through this asset by asset, is that if reset the cost base of an asset, you bought it for $10 on June 30, it's sitting at $15. So there's a $5 gain there. You decide to apply for the CGT relief, but by the time you go to sell it, it's fallen in value to $5. Then you can't sort of the loss there is sitting at $10, which can be of value to you. But you need to be aware when it's going through the changes and what's going to happen. You need to have an idea, or be looking to the future on what you think that asset might do before making the decision.
Yeah. And as you've said, Max, I mean, for those who haven't sought out financial advice, I'd strongly urge you to do so. You've got 14 days, as I said right at the start. So get on the phone, make an appointment with Bruce, Max, or another financial advisor, but just make sure you do, because you won't have a second chance. Now I'll get on to just another quick, I think this will be a quick question anyway. If I contribute 24,000 to my super, it'll drop them down to a lower tax bracket. Can they do it in one hit? I think the answer is, if you haven't used up all your entitlements.
Depends.
Well, we're going to have to make a couple of assumptions here to answer this question. We have to assume that that the person is self-employed and that they're able to make a tax-deductible contribution
Yep.
on their own behalf. If they're an employee or earn more than 10% of their income from being an employee, then they can only do it through the employment source or through their boss or through their employer. If they are self-employed and they are not, you've also got to be careful, because a lot of people who are self-employed are employees of their own company. There's some things that you need to look at. But if they're truly self-employed and are able to make contributions on their behalf, then putting in $24,000 if they've still got that left in their cap for this year, then potentially they can do that to get the tax deduction. It doesn't have to go in particular amounts. A lot of self-employed people will make all of their contributions, their tax deductible contributions for the year in July. In the next 2 weeks.
Yeah.
It's fairly standard. So assuming this person is self-employed, meets the rest of those criteria, then they can put it in a one sum.
The other thing to be careful about, given that unless the aim is to maximise super prior to the new regime starting, you have to be careful to make sure that after the deductible contribution, that their income does not slip down to a point where they're not paying tax on a portion of it. Because if that happens, like if you contributed $24,000 and it went down to $18,000, in actual fact there's about $2,000 of extra income that they could have earned and not paid tax because of the low income tax offset. So again, you need to be careful when you bring in the arbitrage of the tax rates, because there's not much point in putting $2,000 in and paying 15% contributions tax when you wouldn't have paid tax on that anyway.
Yeah.
So you need to look at it. For the first, in that case, in that example that Max has just done, the first 3,000 that reduces your income from 40,000 to 37,000, you're going to get the difference between 34.5 cents in the dollar and the 15% tax rate. So there's a 19.5% tax saving. The amount that you put in that drops you from 37,000 to, depending on a few things, but about $20,500 with LITO. That's swapping a tax rate of 19 or 21% with a 15% tax rate. But yeah, any time that you go below that LITO threshold, which is about $20,500, you're not going to be paying any tax anyway.
That's right.
So you'd be paying tax 15% on the way in rather than paying zero to keep it out. And if you still want to get into super, put in that last, what are we saying, $3,000, $4,000, $5,000 into super as a non-concessional would be a better idea.
And as you said, we have to draw assumptions as to what this person's position is. We just don't know.
Yep.
Next question is around the 1.6 million, but it's for someone who's in accumulation phase. He and his wife have both got 1.6 million. They're in accumulation phase, so he wants to know about whether he's eligible to do the capital gains tax reset, or if it only applies if you're in pension mode.
Only in pension mode.
It's only in pension. If you're still in accumulation, then you're still paying full tax on income and gains in the super fund anyway. So
the thing that couple would need to do, if they have the ability, if they haven't used up their non-concessional contribution caps previously, to be getting 540,000 in, because come 1 July, if they've got 1.6 million or more in their super fund, even if it is an accumulation accounts, they will not be able to make further non-concessional contributions. So that's a major thing that they should be thinking about.
And another thing to possibly consider, Max, might be could they start a pension? If they're able to start a pension before June 30, so that they can apply for the CGT relief. They might be 61 and 62 or something like that.
True.
Haven't turned on the pension because they don't need the income. Might it be worth going and starting the pension very quickly in the next 2 weeks to allow them to apply for the CGT relief? Or
they could have forgotten that they did a letter and minutes of their trustees back on the 1 July saying that they wish to start a pension back then, and as long as they draw their minimum by the 30th of June.
Speak to your accountant.
Yeah. Speak to your accountant. We don't know how old you are, but you might be able to do something, depending on how old you are.
Yeah.
Yep. Next question is actually to you, Max. It's around contribution rules before and after June 30 with non-concessional contributions. So it's quite a longie, but the gist of it is that instead of making a full 540,000 contribution this financial year using the bring forward rule, you could do a 300,000 contribution, which would leave you additional to do next financial year.
If you don't,
because the rules are changing.
yeah,
obviously.
if you either put in 540,000 if you're able to,
Yep.
up to the 30th of June. If you don't make the 540, but you contribute more than 180, which is the current annual limit,
Yep.
in that example, if they put in 300,000 at the 30th of June, under the bring forward rule, the maximum amount they end up having
It's
is
180 plus 100 plus 100. I
Yeah,
would think. So,
so-
they end up with 380. So you put in the 300 now, they would still only be able to do another 80,000 over the next 2 financial years. So FY18 and 19. If you can put in the 540 now, you can. If you trigger it this year by putting in more than 180, then you're still restricted to what the concessional contribution limits are for those years. So you'd have the 180 for this year, plus 100 for FY18 and 100 for FY19.
Yep.
So you don't get by triggering the pull forward provisions doesn't give you that 540 to do over 3 years.
could work against you too. In fact, you know, if with what we're talking about, they'd actually be better to be putting 180 in, and then they could be putting 300,000 in
Potentially,
July,
yeah,
so
yeah.
they've got 480 in. Whereas if they trigger that bring forward, there is that limiting factor.
Yeah, yeah, definitely, definitely. I mean, June 30 is the cut-off for being able to take advantage of the current rules, and
Yeah.
then after that it's going down quite dramatically.
Yeah.
Yep. All right. Moving on to the next one. A 2-member SMSF holding more than 1.6 million. This is a bit broken up, so I'll try and sort of pull it together. The assets made up of cash shares, unlisted, and managed funds in tax-free pension accounts. The second member under 60 having a current nil balance uses the bring forward rule, which we've just been talking about, to bring the total cash in the funds up to $1 million. Can the trustees then nominate $1 million of the non-cash assets held by the first person for the CGT relief reset?
That's an accounting question, I
It's
think.
a pretty complex question.
So the interesting thing is, you have to go back to basics. Each member has their own accounts, and the only way they can get increase those accounts, if it's an accumulation account, it has to be by contributions, concessional or non-concessional. The only way to increase a pension account is by rollover from accumulation to pension. So a person's account is a person's account. If a person is in a self-managed super fund with a nil balance at the present and they're under 60, and you've got another member there who I don't know how much they had, if
I think it was 1.6.
I'll tell you in a minute.
I think the start of the question was there was 1.6 million in the fund.
There's $1.6 million in the fund.
and that's all in pension phase.
Yeah, the first member doesn't say what.
Well, if let's assume
it looks like the first member's holding the whole whole lot.
Well, that member should be in pension phase. Hopefully, they've met the condition of release. I mean, let's assume they've met the condition of release and are able to have an account-based pension. It would be absolute craziness for them not to get $540,000 out into a joint account. The member who's got a nil balance should then make that $540,000 non-concessional contribution. It's got to hit the bank account before the 30th of June, because then what you'll have, that couple will have, they'll go from one person who's got no more money they can put in to another person who can put up to 1.6. Is that you're going to have the other person still being able to put another 160,000, the other person putting in, put in another 600, and another bit more than $1 million. So that is almost a no-brainer. If all
Depending
those
on
conditions,
ages and being able to make contributions and the like. For that, for the person asking this question, but related to what we're talking about here, is the importance of evening up super balances is critical going forward.
Yeah.
It was important pre 2007. It has not really been important for 10 years. But for the fact that if anybody knew this legislation was coming in then they should have been doing it. But there was no tax necessity for doing so when you could have an unlimited pension account. But for needing to do this going forward is important. I've written a couple of pieces in regards to couples evening up their super balances, which is going to become crucial from. In this example here, if they're both in their, say, early 60s, but one has met a condition of release and can pull the 540 out and put it in for member number 2, that's great. And it's also going to be important if that member number 1 is still able to make contributions to super. That would take them over the 1.6 now. But if they're still able to make concessional contributions because they're still working, or other non-concessional contributions, then it becomes even more important to get this 1.6 and 0 to 1.05 and 540, 540 to make sure that people work towards evening up super balances between couples. And it's going to take some work and ongoing work for a lot of people on an annual basis.
That's a perfect segue into a new tax superannuation planning strategy that I came across yesterday. It's called divorce, right? Under one of the few things that will decrease a person's pension transfer account balance is a divorce settlement. If you've got a couple that are older than 75, they are unable to even things up. In fact, there's been a lot of questions that have been coming through. You've got the traditional situation where one of the couple has maybe $3.5 million in super and the other one has nothing. And because they're over 75, they can do nothing. Now, I know, because I can, from a personal point of view, know that my dad was a bad snorer and he slept in a different bedroom to my mother for a long time. One of the conditions of divorce is not necessarily, you can be living under the same roof, but you can be separated. So one of the strategies could be, if there is a couple in that and they're happy to put their hand on the heart and say, no, I can no longer stand this person, we're going to get the divorce. And in the divorce settlement, we could have a situation where half of the one of the people who's got the large amount goes across to the other. That fixes it.
How many times do you have to say, I hate you, in order to qualify for this?
I think being married, there wouldn't be a couple on the face of the earth that wouldn't have ended up having at least met that quota, I'm sure.
Of course. Well, it makes perfect sense, yeah. So there's a lot of strategies that are coming out that nobody's going to know all the strategies yet, but that's
So the bottom line is a divorce rate could go up quite sharply.
Particularly
in
the over
the
75 market.
octogenarians, yes, that could be a major. Yeah.
We'll
And
keep
in
an eye
fact,
on it.
I
I
hope
think
there are
there's a
no-
story in that, Max.
Yeah, well, I hope there are no solicitors learning, because then that'll be the next thing they'll be chasing, the next ambulance they'll be chasing. So
I look forward to that story. Now the next question is from Godwin. 64, working part-time, proposes to work to 66, maybe a little bit longer than 66, but not beyond 67. Wants to start making arrangements for a recontribution strategy to move from taxable to non-taxable. What are the requirements to put that into place?
Well, if 64 at the moment, and you need to remember again that the $540,000 limit ends on June 30,
Yep.
And that you move. So there's a couple of things here. One, the 540 finishes on June 30. After that, maximum using pull forward is $300,000 or $100,000 a year. Second thing is that he's 64, and once you turn 65, you lose the ability to use pull forward. So at age 65, you could only do $100,000 a year withdrawal and recontribution potentially. So there's a couple of things here that he needs to talk to somebody about and strategise. But one of those might be, you've got 2 weeks. It's not impossible to do some of these things in 2 weeks, depending on your super fund. But it's something that may well be worth considering getting urgent. Make an appointment with somebody now. Style advice to make some of these strategies worthwhile.
And the other thing to look at, and I've had a couple of cases that I've been looking at, and when you drill down and ask the questions, if this person may be working part-time now and they're 64, and at some time between them having turned 60 and their current situation. If they ceased employment with an employer, that is a condition of release. Now, a lot of people don't think, oh, I've just decided I've had enough of this job, or I've been made redundant, and run off to their super fund and say, I've met a condition of release. So they go from preserved to non-preserved or unpreserved. If this person has met a condition of release and has some documentation to prove it, there would be nothing to stop them to go back and say, hey, I met a condition of release back here. I should be unpreserved, and it'd be for their balance at that date. So maybe they had 300,000, who knows what it was. And if they're over 60, they could be getting, depending on the numbers, as long as they met that condition of release, 540,000 out before the 30th of June and getting it in. But this is where SMSFs are superior to, by now the chances of doing that even with a commercial fund or an industry fund would be pretty hard. But from a point of view of a self-managed super fund, unless all of the investments are tied up, it's something to do. But there needs to be more investigation for something that could be possibly done before the 30th of June.
We all come back to June 30. It's the deadline. So move on it, listeners. Again, if you haven't sought financial advice, you really should. You haven't got that long to do it.
There is an old saying, the end is nigh.
The end is nigh.
Yes.
Of course. Now, the next question is around what we don't really have in name. We don't have inheritance taxes per se, but there are taxes that can apply after one's death. This person wants to know, what are the taxation rules around children inheriting super funds from a parent?
Well, if a child, as in under 18, if we're talking a child by legal definition under 18, then anybody who dies, their super can pass to their spouse or their children tax-free. And it doesn't matter about taxable and tax-free at that stage. It passes to financial dependence tax-free. If you're talking about children who are older than 18, then there needs to be financial dependency aspects to it as to whether it can
or
can
permanent
pass.
disability, the other one.
Yeah. So
That's it.
yeah, if they're truly under 18, that your partner, your spouse, and your children will get your super tax free. Once they've hit 18, there are potentially some other hurdles that that can be used to determine that, but can receive your super. But children under 18, yeah, not a problem.
And then if they're over 18, they're paying, it's effectively going to be 17%. It's the 15%
plus
the 2% Medicare.
So,
it was 17.5%.
Yeah, on the taxable portion. So if you do have a lot of non-concessionals contributions in there, then it's the portion that is taxable that will be taxed at the 15 plus 2.
Which is an interesting piece of strategy. If there are any super funds where a member has died and the money is going to go to an adult beneficiary, that I wouldn't be in a hurry to wind up and have that money going out before the 30th of June. You're going to save them at least 0.5% on the taxable super going to a non-dependent after the 30th of June, because it effectively ends up being 15% plus 2% Medicare rather than the what it's 2.5% now. So isn't that what it's?
Isn't it going up?
It's so it's a moving feast.
Yeah. I think that was something that came out of the budgets.
Yeah. But there is something that needs to be looked at from that point of view.
Yep. Well, thanks for answering that one, Bruce and Max. The next one is around the $1.6 million cap, as many of the questions are. This person has capital losses. I think we may have answered this one before in a roundabout way, but they've got capital losses. Can those losses be applied after July 1 on the sale of shares? So
that goes back to the question that we were answering before in regards to going through asset by asset and determining which ones you want to apply for CGT relief on and which ones you don't. Again, this is not specific advice. We don't know this person's circumstances. They need to sit down and speak to an advisor and or an accountant in regards to it, but to determine if there are losses there and those assets are going to wholly or partially end up back in the accumulation fund, then it's one of those ones you probably don't want to apply for the CGT relief on, because you want those losses when those assets are sold to be able to be used against gains in the portfolio as well.
I'd like to have a caveat to the seeking the advice. Just because you're using an accountant doesn't mean that they're going to be able to provide the advice or have the experience. There are a lot of people that call themselves tax agents that end up really being tax agents, because all they do is prepare and lodge returns and stuff. So be making sure that if you're going to be getting advice, you need to be getting it from an SMSF tax specialist.
Next question, it's a fairly long one, but the gist of it is that the person is receiving a defined benefits pension, earning dividend income of about, gross income is about $90,000 a year, including the imputation credits. Person wants to know, after July 1, can those dividends be salary sacrificed into an accumulation account that's not the defined benefit account?
It's above my pay grade. That one's yours, Bruce.
Defined benefits, so start with the basics. So the defined benefits, whatever the annual amount they've got is multiplying that by 16, which will determine how much of their transfer balance cap they've used.
Yep. So it's $40,000 a year on the defined benefits.
Okay, all right. So you're multiplying that by 16, and you're getting $640,000. So that's what they've used to their transfer balance cap. And are we saying that they're earning $90,000 in grossed up dividend income stream?
Yep.
So what if that's what they're earning? Then potentially they can make contributions to super, concessional contributions to super, being a self-supported investor. So they can potentially make post July 1 to the $25,000 a year. Other things they might want to consider, as in sit down and talk to somebody about it, is contributing those, making in specie contributions of some of these assets into a super fund. We don't know how old the person is, but getting some of those assets into a super fund might achieve what they're looking to achieve here.
They're 58.
58. Well,
Yep.
you know, how much of the income do they need? So they want to get some of it into a super fund. There's some important planning opportunities for this person, but needs to sit down and take into account how much income they're going to need going forward. Do we try to get some of these assets into super? You know, you've got, if you do that, on the downside, obviously, you're going to have a CGT event on either the in-specie transfer. So if they bought some of the assets for a price and they're going to transfer it in there as a CGT event, they've got to take some, we'll have to pay some tax on. There's a lot of things that they need to be considering, but making deductible contributions, concessional contributions, is something that they could certainly consider doing if that was the basis of the question. But again, sit down with somebody and work through that one in some detail.
Yep. Next question is around salary sacrificing, and you've written a fair bit about this, Bruce, already. But the new rules coming in is going to make it a lot easier for people to salary sacrifice, including self-employed.
Yep.
Which they haven't easily been able to do. The person wants to know, can they essentially sort of put in their annual contribution limit pretty much sort of in around May or June, and then claim it once they do their tax in the following financial year?
So the reason that the reason this is going to become really powerful is a really big benefit of some of the changes that have been made. We've focused on the 1.6 and the 540 dropping to 300 and the 35 and 30 coming down to 25. One of the big benefits of the new legislation is essentially the removal of the 10% rule. So employees at the moment, if they are on just say $100,000, they're getting $9,500 via the 9.5% SG levy paid into their super. If their employer doesn't offer salary sacrifice, and there's no compulsion, employers don't have to do it, then they've got no way of getting any extra money into super under concessional contributions. They get their 9.5% in, the employer says, no, I'm sorry, we don't do salary sacrifice. That's it, they can't do any more. Under the rules that come into place post July 1 is that anybody, any employee is going to be able to make concessional contributions and claim a tax deduction for it. So to extend that example that I was just doing, they've used $9,500 of their $25,000 limits that will apply post 1 July. They could put in up to another $15,500. They get round to May or June, they can go in and put in $15,500 into super. The $15,500 will be taxed at 15%, but then they'll get a tax deduction based on that contribution. So essentially, they're allowing, they're getting rid of the need, really, for salary sacrifice. For a lot of people, salary sacrifice is still the best way to do it. If your employer will do it, you know it'll be done weekly, fortnightly, monthly, whenever it is. You won't have to. You won't be responsible for putting the money yourself, and that'll continue to work. And a lot of employers will probably continue to offer salary sacrifice. There's no actual need for it anymore. So long as you can get the money and not spend it through to May or June, then putting it in as a lump sum in May or June is fine. If you want to put it in weekly, if you know that you'll be able to do that $15,500 again, to use that same example, which is a bit under $300 a week, then you can do that. You can make these contributions to super on a weekly basis or a monthly basis or whenever you want to. So the removal of the 10% rule is a massive improvement for a lot of people. Not everybody, but a lot of people.
Yeah.
And it actually opens up a couple of strategies. One of the unintended consequences of the salary sacrifice regime that none of the governments of any political persuasion have ever wanted to correct is that under the current legislation, the 9.5% is effectively payable on a person's taxable salary. There are some employers, I would never dare calling them unscrupulous, I'd probably use an even harsher term, is that if someone's on $100,000 and using the example, the employer would have to be putting in 9.5. If they chose to, given the old rates, and I want to keep this simple for my poor brain, to do $20,000 salary sacrifice, under the rules, that employer is perfectly able to only put the 9.5% on the $80,000, costing $1,900 of employer. So bringing in this or changing the law means it would be ludicrous for someone to be maximising their salary sacrifice in that situation. They'd be a lot better to end up having have their taxable salary, get the 9.5 from the employer, and then only have to put in 15,500 or whatever it is from their own. So that's one thing that will be corrected as a result of the current legislation. The other, if someone's got a lot of investments, and I expect everybody that's listening and watching this would be, or they wouldn't be subscribers of Eureka or InvestSmart. If you've got a lot of investments outside of superannuation and you meet the work test and are able to make self-employed super contributions, it'll be a great way to start to end up selling up investments, claim, even if you are employed, and let's say they're getting a $15,000 contribution from their employer because they got on a good wicket. Now that means that they could be putting in a deductible $10,000 contribution, which effectively translates to a $20,000 taxable gain that they've made. So they sell the investment, make a $20,000 taxable gain. That might be $80,000 that gets into super, or $70,000 gets into super. They make the $10,000 concessional contribution. They're only paying 15% on $10,000 rather than their marginal rate. So that's going to be another great strategy because they haven't brought in the 1.6 million cap because superannuation is a bad retirement investment. They've brought it in because it's the best game in town.
I'd actually love to go back and find the public servant or the politician who introduced or thought that the 10% rule was a good idea and get them to explain exactly why they put it into place, because it's never made any sense.
No.
And it's
called envy.
Well, but
it was just an unnecessary restriction.
It was an unnecessary restriction that didn't apply to the self-employed, hurt a lot of employees, and completely stuffed those who are part of both. If you're a part employee and part self-employed, then and you earn more than 10% of your money from employment, then that's the only way you could do it. You could only get your money into super via there. And now, if you only earn $10,000 a year, from that employer and $90,000, so whatever, $20,000 and $80,000, you could only put in because that's more than 10% of your total earnings. You could only put in super from that $20,000. So if your employer is putting in 9.5% of that, $1,900, and didn't offer salary sacrifice as an option, then you were limited to getting $1,900 a year into super, even though you earned $100,000. So anyway, getting rid of the rule, it's one that's never made sense, and I don't understand.
You know the reason why?
Why?
The people who came up with it ended up having defined benefits, and they never had to worry about it.
Probably, yeah.
Yeah, well, exactly right.
Yeah.
But I think what it will do, though, is see a big rise in the number of people salary sacrificing, which at the moment,
Well, they're going to have to find a different name for it, because salary sacrificing is
personal
specifically
deductible contribution is what they're calling it. Personal deductible. The other interesting things, and I'm not sure whether, and you might know this, Bruce, and I've got it in the back of my mind that might not end up being benefit. Currently, if you salary sacrifice, it becomes a reportable employer super contribution, which is counted to assess whether someone's paying more Medicare levy, getting some various government benefits and stuff like this. I'm not sure whether personal deductible contributions will be a part of that new regime to be counted to add back onto your tax to come up with. And if it's not, that will be great. If I just hope there's no one in Canberra listening to this.
But look, depending on how it's counted, that could be important for a number of strategies, including one that I do deal with occasionally, which would be separated couples and payments that are made from one spouse to another in regards to that. And
childcare is too another thing. It's amazing. The number of, and I've come across this from the personal point of view, someone who wants to go to 5 days a week, that 90%, because of where they end up in their income stream, 90% of the extra day's income is going in extra childcare. Just absolutely crazy.
Yeah, and that's the cost of childcare. It's enormous.
Yep.
Now we've got about 10 minutes to go, so we'll try and get through as much as we can over the next 10 minutes or so. I think this one's pretty quick. The question is around someone having 1.6 million in their pension. They want to know if the future gains on the 1.6 million can be carried over into the pension, which I think they can, or do they have to be rolled out?
But basically, you've got to go back to rule number one, is that the only thing that increases a pension transfer balance account are the rolling into an account to start a new pension or pension balances at the 1st of July. The only thing that really decreases your pension transfer balance account are commutations. So therefore, on the one hand, one thing that will increase a person's pension account in their super fund will be income. That doesn't get counted. And the other thing that decreases their members' account balance are pension payments. That doesn't get counted as a decrease. So when you take those out of the mix, this is why it's so vitally important for people who end up with an excess amount in an accumulation account to only ever draw the minimum pension payment, and if they've got an accumulation account, take partial commutations if they need more than that, or if they only have a pension account, still only ever take the minimum pension and have extra that they need as partial commutations. So if they started off at 1.6 and the minimum that they need to be taking is say 80,000, 5%, I hope I got that calculation right. Let's say they need 100,000 a year, they'd be taking the 80,000 and the extra 20 is a commutation. So after 5 years, their pension transfer account balance would have gone from 1.6 down to 1.5, and if they met the conditions, they could put in another 100,000.
That's it. I mean, exactly. Keep your higher balance in that pension account, in tax free. Next question is around. I'll just read this one. It's a long one. I believe it's still possible to make a non-concessional contribution in a super of up to 100,000 once a person has reached age 65, provided they meet the work test. does this happen? Does this need to happen in any particular order? As in, do you need to meet the work test first before you can contribute that, or other way around? Also, can the work be any sort of work, including self-employed work, provided there is evidence that the work took place?
I would be, you'd want to probably not make the contribution until after you've met the work test in most cases, I would think, because something might happen that stops you completing meeting the 40 hours in 30 days. Any number of things could happen. You don't want to put it in and suffer the penalty as a result of that, but literally once you've met the work test, which is 40 hours work in a 30-day period for the year, that covers you for the entire year. So if you do that in the first week of July or the first 10 days of July, then you've got for the rest of the financial year to get that amount of money in. As long as you don't turn 65 or before you turn 65, you can do it even if you turn
up to 75.
Sorry, yes, of course, we're talking about somebody saying that they're older than 65. Sorry, they meet the work test, they can get the money in as long as they're before 75. The other thing that was in that question
is the being, from a point of view of being able to be classified as gainful employment.
Yes.
You must have been paid for it, right? That can be delivering advertising pamphlets.
Yep.
Unfortunately, being paid for the babysitting of the grandchildren does not qualify unless you're doing it as a professional and doing it on rotation for a number of people, so that you're effectively an independent child sitter. And if you're self-employed, you'd have to be able to show, here are the hours I worked and here's the income I produced. You can't just, I'm a self-employed philosopher and I've spent 100 hours in the month in looking at my navel. You'd have to be paid something for being that self-employed philosopher.
Exactly. Next question, a couple more actually. Next question is around restrictions on working once you've commenced an allocated pension. Is someone able to work part-time? Can they work full-time?
If you're 60 and have finished work, changed employers or resigned, retired, then you can turn on your account-based pension and have your money be fully unrestricted, non-preserved. If you subsequently make a decision that you need to go back to work, then the ATO can't sort of say, well, no, hang on a second, you said you retired, you can't go back to work. People can change their minds. They might need to change their minds. Their financial needs might have increased, or they might just get bored after 3 or 6 months or whatever in retirement.
The GFC was a great indicator of that.
Yeah, a lot of people who would have at that stage watched their $1 million turn into 500 or 600 or whatever. And all of a sudden, their retirement is they needed to go back to work. They couldn't live off what they had there anymore. So the ATO can't and doesn't want to tell people that you can't go back to work. You can after you started an account-based pension. Yeah.
In fact, that GFC thing was a great. We should have had that as a segue into Ron's presentation when we were doing the roadshow about the importance of having balance within your SMSF investments.
Most definitely. Last question for today is someone, if your defined benefit pension is above $100,000 a year, and in the second fund currently in accumulation is $600,000, I gather there is little use in converting that to pension or TTR made prior to July 1.
No, wrong.
Well,
Definitely.
there absolutely may be. If you got the 100,000, so this is going back to that question about DB pensions. The 100,000, whatever your DB pension is, multiply that by 16. That's how much of your 1.6 million transfer ballot cap that you've used. So this person has used a $100,000 pension. They've used their 1.6. Well, the other 600,000, as we were sort of talking about a little bit earlier, in some cases it may make sense to turn on a pension to allow you to get the CGT relief on those assets. If the assets are due again, you've got to go through asset by asset. But that's one of the strategies that becomes quite important and something that there may well be a lot of people who desperately urgently need to go and see somebody about getting some of these things done, because there's some potentially big tax savings in an
from the
example
capital
like that.
gains. And in
Yeah.
fact,
Capital gains income.
they would have been the people who've forgotten that they sat down on the 1st of July and wrote the letter to themselves as trustee saying that they were starting an accumulation pension at that time.
Well, gentlemen, thanks again for coming in today. It's been great. We've covered a lot of ground. We won't go through the June 30. I was just joking then. So you can breathe a sigh of relief.
Okay.
Thank you.
And same to you, listeners. Thanks for joining us again on Advisor Q&A. Please join us again. Our next session will be in mid-July. I'll get the dates up on the site as soon as possible, but do see your financial advisor before June 30. That's our main advice today. Thanks for joining us.